I had the coolest job that any electrical engineer could ever have on the ground crew for Solar Impulse 2, the first solar-powered airplane to fly around the world only using the power of the sun. IEEE USA has given me a competitive edge because of their support system. It is so much easier doing something and being out of your comfort zone when you have someone there saying, "You got this." IEEE USA is more than just a network. It's a family.
Good afternoon, everyone. Welcome to our IEEE USA webinar, Giving with Purpose, Tax-Savvy Approaches to Charitable Giving. I'm your host, Jonathan Cho. Today's webinar is in partnership with the IEEE Foundation. Our guests for today are Karen Gallucci from the IEEE Foundation and Jorden Cohen of KBK Wealth Management. Karen is the Executive Director of the IEEE Foundation, the philanthropic partner of IEEE. She leads the IEEE Foundation professional team and partners with the IEEE Foundation Board of Directors to nurture strong and effective partnerships that bring the promise of technology and the knowledge to use it to individuals and communities all over the world. At the end of 2020, the IEEE Foundation successfully concluded its first ever comprehensive fundraising campaign called the Realize the Full Potential of IEEE, raising $32.1 million. In recognition of her exemplary performance and impact, Karen received the 2010 Joyce E. Farrell Staff Award from her fellow IEEE staff members and the 2016 IEEE Eric Hurst Outstanding Staff Member Award from the IEEE Board of Directors. Without further ado, I will now pass it off to our first guest. Welcome, Karen. Very excited for what you have in store for our audience today, who will also introduce our second guest, Jorden. Welcome, Karen.
Thank you, Jonathan. It's a pleasure to be with everybody today for Giving with a Purpose, Tax-Savvy Approaches to Charitable Giving. As Jonathan shared, my name is Karen Gallucci, and I have the privilege of serving the IEEE community as the Executive Director of the IEEE Foundation, IEEE's philanthropic partner, and as you can imagine, this is a topic near and dear to my heart. The IEEE Foundation is the heart of IEEE charitable giving. We work together with IEEE and our donors to deliver opportunity, innovation, and impact across the globe through a wide array of IEEE programs. These programs run a wide gamut. They can be the IEEE MOVE program, which deploys in response to natural disasters. They can be educational initiatives that nurture the next generation of engineers and technologists through STEM initiatives, through the IEEE Tri-Engineering program, or a wide array of scholarships and fellowships that encourage young people to pursue a career in engineering and technology. And then there's the IEEE USA programs that we work so closely with, including its Government Fellows program, which works to bring U.S. IEEE members to Washington, D.C. as advisors to members of Congress and federal agencies. Registered in the state of New York, the IEEE Foundation is a 501c3 public charity, and we are proud to earn top ratings from both Candid and Charity Navigator. Now that I've given you a flavor for the work of the IEEE Foundation, it's my pleasure to introduce the main speaker for today's event, Jorden Cohen. Jorden is a financial advisor at KBK Wealth Management in Midtown Manhattan in New York City. Jorden has numerous licenses to his name, including a certified financial planner, certified plan fiduciary advisor, investment advisor representative, and a licensed insurance broker. Jorden specializes in comprehensive financial planning for individuals and families, serving as a fiduciary to guide clients in areas such as retirement planning, tax planning, investment management, estate planning, insurance and risk management, cash flow and budgeting, and charitable giving. He also consults with small to medium-sized businesses and nonprofits to design and administer retirement plans such as 401ks and 403bs. When working with his clients, Jorden takes a holistic approach to financial planning, integrating his clients' personal values, emotional well-being, family dynamics, and life goals into their financial strategies. He emphasizes the importance of aligning generosity with tax-efficient strategies, enabling clients to maximize their philanthropic impact without compromising impact and financial security. And isn't that why we've all decided to sign on to today's webinar? So without further ado, I'd like to introduce Jorden and let him share all of his wonderful insights with all of you. Thank you, Jorden.
Thank you, Karen. I appreciate it. Hello, everyone. Thank you for joining. My name is Jorden Cohen. Like Karen said, I'm a certified financial planner and a financial advisor with KBK Wealth Management in New York. And I'm truly excited to be here today. First of all, big thank you to the IEEE Foundation and IEEE USA for hosting this webinar. It's an honor and a privilege to speak with all of you at IEEE. I feel fortunate, to be the one that gets to share these practical strategies with you, even if the topic can get a little bit dry at times. So my goal today is going to keep it concise, cover the key points, and leave you feeling confident about charitable giving so you can get back to your day with something useful in your pocket. Just a quick disclaimer before we start, everything that we'll discuss today is general education, not personalized advice. So we will have a Q&A at the end. Please feel free to type your questions into the chat. But I won't be able to offer specific guidance for your situation during the Q&A session. However, I will share my contact information at the end. So please do not hesitate to reach out to me privately. I'm happy to be a resource for all of you. So I'd be happy to set up a time for a private conversation to dive into your personal questions and tailor some advice directly for you. All right, so what are we going to discuss today? First, we're going to do a quick introduction on taxes. I promise I will keep that part quick. We'll discuss some of the rules that are relevant for charitable giving. Then we'll explore some specific strategies like qualified charitable distributions, donor advised funds, donating appreciated assets like stocks. And then at the end, I'll touch on a few more advanced and unique strategies. We'll wrap up with closing thoughts and a Q&A at the end. Now, I know taxes and financial planning probably isn't what gets most of you out of bed in the morning. Some of you in your day-to-day may be building systems to run efficiently, and I do a similar thing, but with your finances instead of technology. So that's a big part of my job, is helping people keep more of their money and send less to Uncle Sam. So why give with purpose, right? So giving is a fantastic way to support what you care about, whether it's tech education, research, or something entirely different. But here's the kicker. Doing it strategically is like optimizing a system. You can boost your impact without spending more out of pocket, right? So imagine donating $1,000, but with a few smart moves, it's more like giving $1,200 because you're saving on your tax bill. It's all about doing good, cutting taxes, and maybe even planning a legacy all at once. So why be strategic? Not all giving is the same. The US tax code is an absolute beast. It's over 6,000 pages of fine print, but it does include some ways to stretch your donations further. So most people just toss some cash at a cause and call it a day, missing out on even bigger savings for themselves. So I'm here to show you how to use things like retirement accounts or investments to give smarter, not harder. It's about keeping more for your priorities and the causes you care about and handing less over to the IRS. So what you're going to learn today, by the end of today, you'll know how to give tax-free from your IRA using qualified charitable distributions. We'll talk about a donor advised fund for a lot of charitable giving flexibility. You'll learn how to donate stocks to skip out on capital gains taxes. And we'll even explore some of the more advanced strategies using trusts. I would think of this like a user manual for efficient generosity, less waste, more output. So let's start with the tax basics. I promise I'll keep this part quick. All right, so taxes. I try my best to make taxes exciting, but that usually works just as well as a stock tip from your cousin. It doesn't usually work out, but it is the foundation for all of this, so please bear with me. I'll zip through and focus on what you need to know to make these strategies work. The key point here is not every donation saves you taxes, at least when it comes to getting a deduction. So unless you're using some strategies that we'll cover in a little bit, you have to itemize deductions to get a break. That's the magic word here, is itemize. I'll explain what that means in a second. On the screen, there's a few topics that we'll discuss, and I will go ahead and explain each. So above the line and below the line deductions. Taxes are a two-part game, right? So first you have above the line deductions. These are known as adjustments to income. This can be 401k contributions, health insurance premiums. These lower your income before the IRS starts taxing you. So if you get a paycheck, you'll probably see some of these above the line deductions listed on your paycheck. And then below the line deductions, we have charitable gifts, mortgage interest, state and local taxes. These only matter if you itemize your deductions. So think of it like this: above the line stuff shrinks your taxable pile first, and then below the line, like your donations, only helps if you skip out on the standard deduction and instead itemize and list out every itemized deduction. This will be easier to explain with an example, right? So we have a quick example here: a married couple with a combined income of $200,000. Throughout the year, they make some retirement contributions. They, pay for their health insurance premiums. Those are the above the line deductions that gets their income down to $165,000. $165,000, that's their adjusted gross income. This is the line, okay? Then below the line, this couple can either deduct the greater of the standard deduction or the sum of all of their itemized deductions. So the standard deduction for the 2024 tax year was $29,200 for married couples. If this couple here in this example adds up all of their itemized deductions, including their donations, their itemized deductions are $32,000. In this case, itemizing results in a greater deduction, right? So they itemize and their taxable income drops to $133,000. So let's just say part of their $32,000 of itemized deductions was a $10,000 charitable donation that they made to IEEE. Very, very generous. But let's say instead they only donated $5,000. In that case, their itemized deductions would be $27,000, not $32,000, which is less than the standard deduction of $29,200. In that case, they would just take the standard deduction, so their $5,000 donation, while it was very generous and very impactful, it didn't get them any tax breaks. So itemizing is the key, right? I'll keep saying that. In 2024, the standard deduction was $14,600 for singles, $29,200 for couples. This year, that bumps up slightly to a flat $15,000 for single filers and $30,000 if you're married filing jointly. So if your total below the line deductions, charity, mortgage, state taxes, if that doesn't top the standard deduction, you're stuck with the standard deduction, and charitable giving doesn't cut your taxes. So there's a quick tip here. If your itemized deductions, you add them all up and you're close to the standard deduction, but you're still a little bit under, maybe it might make sense to combine a few years of donations into 1 year to beat the standard deduction. We call this strategy bunching, right? So a lot of people will decide, they'll pick a number and they say, I'm going to donate $5,000 per year to charity. There may be cases where you want to donate $10,000 this year and then nothing next year, as an example, so you can beat the standard deduction and get a tax break. Quick detour, we'll talk about capital gains tax. So if you sell an investment that's up, like a stock, you're going to owe capital gains tax on the profit, which is between 0 and 20% based on your income, plus potentially state taxes. But if you donate the stock instead, there's no tax on the capital gain. I will dig a lot deeper into that later in the presentation. So how much can you deduct in 1 year? With cash, if you just donate cash, you can deduct up to 60% of your adjusted gross income in 1 year. A stock that you've held for over a year, you can deduct up to 30% of your AGI in 1 year. And then stocks held less than a year, you can deduct up to 50% of your AGI in 1 year. The total combined amount that you can deduct in 1 year from charitable donations is 60% of your adjusted gross income. So no, you can't use charitable donations to bring your taxable income to zero. However, the excess deduction that's over these limits can be rolled forward, carried forward for up to 5 years. So you can use the remainder you couldn't deduct this year, next year, and the year following that if you're over the limit again. Key takeaways here on the taxes: you need to itemize your deductions, right? So your itemized deductions need to exceed the standard deduction to get a tax break on your charitable donation. Consider your timing, right? So some years it may make sense to donate more this year and then less or nothing next year. Understand the deduction limits, but again, excess deductions can be carried forward to the next tax year. And lastly, choose the right assets. Most people just donate cash from their bank accounts, but if you donate a stock, you can avoid capital gains taxes. So now that we know the tax basics, I will get into some specific strategies. Okay. First up, we have qualified charitable distributions. This is a very strategic way to give directly from your IRA. So what's a QCD? You have to be over 70 and a half years old to do this. So if you're over 70 and a half years old, you can send money straight from your IRA to a charity. Normally, IRA withdrawals mean taxable income. A qualified charitable distribution comes out completely tax-free. It doesn't even show up on your income. Where this gets really impactful is for those over the age of 73. So at age 73, you must start withdrawing a certain amount from your IRA every year. This is called a required minimum distribution. Required minimum distributions, or RMDs, they're based on your age and account value and can get larger as you get older. This is so Uncle Sam can finally collect taxes on the money that you've stocked away in your retirement account the past 50 years, regardless of whether you need to take it out or not. They're going to make you take it out. So a QCD counts towards your annual RMD requirement without increasing your taxable income. So it's like rerouting power, right? So instead of the government collecting your money, you give it to charity instead.
So Jorden, would an idea be that if you wanted to start before the RMD kicks in at 73, because you wanted to lower the balance in your IRA, that's when you would take advantage of the 70 and a half?
That's exactly right. So, the more you move out of a traditional IRA or a rollover IRA account, the less the government's going to force you to take at age 73. If you're a little bit younger right now, that age is actually 75, so maybe 75 for a lot of you. But yes, for the same reason that people make Roth conversions from their IRA accounts, people will take QCDs before RMDs start to lower their balance and then lower future RMDs. It's a good question. So how these work, right? So again, who's eligible? Anyone over 70 and a half years old with a traditional IRA. This cannot be done from a 401k or a Roth IRA. Last year, the largest QCD that you could make was $105,000. This year, that's up to 108. Couples can both do this, right? So for a total of 216,000 in 2025. The last bullet point is the most important here. The money must go directly from your IRA custodian to the charity, no middleman, right? So if that money hits your bank account first and then you donate it, that's taxable income. So do not take possession of the money if you're going to do this. Why use a QCD? Again, if you're over 73, the IRS is forcing you to take money out of your IRA every year for RMDs, and you don't need it because you have other sources of income, maybe Social Security, your spouse might be working, and you want to be charitable. This might be the best way to donate, right? So you avoid having to add your RMD to your taxable income if you do a QCD. Another big bonus here is if the RMD you're forced to take would push your taxable income above IRMA thresholds, a QCD can help keep your Medicare premiums lower. So people on Medicare might be familiar with IRMA. If you do an RMD, this does not count towards those IRMA limits. This is separate from itemizing, right? So this is to avoid paying taxes on money coming out of your IRA. doesn't have anything to do with deductions. All right, so even if you don't itemize, you can still get a tax benefit by avoiding that taxable income from the IRA. Most importantly, the charity gets the full amount of your donation with no taxes. A few downsides, okay? You do have to be over 70.5 years old to do this, so apologies to people around my age. This doesn't apply to you yet, but it will one day. It must be an IRA, so some people will roll over their 401ks or 403b plans to an IRA to take advantage of this. There is a cap of $105,000 in 2024, $108,000 in 2025, double that for married couples. The IRS does this to prevent people from dumping IRA accounts they don't need to a charity, so they can avoid taxes on the whole thing. And then lastly, if your IRA provider just transfers your IRA distribution to your bank account like they normally do, you can't use that money to make a QCD. That unfortunately is taxable income. Quick example here, we have philanthropic Phil. He's 73 years old. The IRS is starting to force him to take required minimum distributions. So this year he's required to take $10,000 out of his IRA, and he doesn't need it. He has other income. So he takes it. He takes the $10,000 as income. He owes $2,500 in taxes at a 25% rate. But if he does a QCD instead, $10,000 goes straight to charity, doesn't increase his income, no tax, right? So charity gets it all. Phil saves $2,500, and that's money staying out of the IRS's hands. So good job to Phil. That's it on QCDs. Pretty straightforward, but powerful, especially those who are forced to take RMDs or going to be forced to take RMDs in a few years. Next up, we have donor advised funds. I like to call this your flexible giving toolbox. I'll explain how they work. This one, there's no age requirement. Anyone can do this. So what is a donor advised fund? Donor advised fund is like a charitable savings account or a charitable investment account. You donate cash or stocks to the account. You get a tax deduction now in the year that the contribution is made. And then the money can sit in the account. You can invest the money. It can potentially grow all tax-free for as long as you want. And then at any point in the future, you can pick which charities to send the money to. So, this is a great thing. If you have a big income year, you can drop your donation into the account, itemize your deductions so you can deduct the donation. And then whenever you want in the future, release funds to whichever charities you would like. This is very easy, right? So you have one account and you get one receipt for your contribution. And then you can make lots of gifts in the future and you don't have to track each one individually. You only get one receipt. Again, how this works, you give money to a donor advised fund account in the form of cash, stocks, bonds, etc. These accounts are widely available. Fidelity has it, Schwab has it, plenty of others. You immediately get a tax deduction in the year of contribution. So remember, you have to itemize deductions and it is subject to those AGI limits. Then once the money's in the account, you can invest the funds just like any other brokerage account, but the growth is completely tax-free. And then you choose who to grant money to at any time in the future. So you can disperse some this year, some next year, to multiple different charities. If you pass away and there's still money in the account, you can appoint a spouse or one of your heirs to take over the account. They become the advisor. That's the person who chooses which charities get money and when. Or you can simply just designate a charity to receive the account balance upon your passing. Again, the bunching strategy works really well here. So if you're close to that standard deduction, it may be worth bunching multiple years worth of donations into the current year so you can itemize and get a deduction now. And then over time in the future, you can decide when and which charities get the money.
So Jorden, can you use the QCD with a DAF?
No, you cannot. I will get to that in a little bit, but no, you can't send money from your IRA to a donor advised fund. Again, a qualified charitable distribution, there can't be a middleman. It has to go directly to the charity. It's a good question.
And when your DAF sends money to the charity, do you get to take another charitable deduction?
No, that's a good point. So you get, remember, as soon as you put the money into the account, that is the completed gift to charity. So you get a charitable deduction for giving money to the donor advised fund. You get a deduction in the year that you make that contribution. And then at any point in the future, you can start dispersing those funds to charities, but you've already got the deduction. You don't get another one. Okay. Key benefits here, I've mentioned these, but you get the immediate deduction in the year of contribution. You have total control, give now, decide to charities later. The money grows completely tax-free within the account. The bunching strategy works great here, and a lot less paperwork. This simplifies record keeping. You only get one receipt. You can disperse your money to 10 different charities, and you only have to keep track of one receipt. Just some downsides to be aware of, minor downsides in my opinion. It is irrevocable, so there's no refunds. Once the money is in the donor advised fund, you can't get it back. There's no personal perks. So, for example, you can't withdraw the money to use it on a raffle at a fundraising event that would, if you won, would benefit yourself. There are some fees charged by the investment company to maintain these accounts, and the money must go to an IRS qualified charity. Again, I consider these minor downsides when compared to the benefits. Here's an example. In this case, we have Benevolent Beth. She had a great year at work, brought home a big bonus this year. Usually, Beth plans to donate $10,000 per year to her favorite charities. This year, instead, she's going to put $50,000 into a donor advised fund. She itemizes her deductions. It gets a big tax deduction this year. And then over the next 5 years, she sends the money from the donor advised fund to her favorite charities. Without this, her itemized deductions might have been below the standard deduction. So this is a very strategic move by Beth. Best candidates to do this, like in the example, people who have a big income year and want to reduce their taxes. Also, people who may donate to a lot of charities and don't want to keep track of all of those receipts can instead just put the total amount for the year into a donor advised fund, get one receipt, and then distribute to charities over time. It makes record keeping a lot simpler. People with appreciated stock who want to avoid capital gains tax can donate the stock to the account, avoid capital gains, and get a tax deduction. And it's also a great family philanthropy tool to allow your family members to continue your charitable giving even after you pass away.
Every one of those examples, Jorden, we've had an IEEE Foundation donor explain to us that's why they use a donor advised fund. So I think those are fantastic examples.
Great. So now donating appreciated assets. I've mentioned the idea of donating appreciated assets to a donor advised fund or just donating appreciated assets directly to a charity. But now we'll take a deeper dive into why this makes sense. So what are appreciated assets? It's any asset, stocks, bonds, real estate, mutual funds, cryptocurrencies, any asset that has gone up in value since you purchased it. Capital gains are the profits earned from selling appreciated assets. So you buy a stock at $10, you sell it at $15, $5 is your capital gain. So once you or your advisor clicks that sell button, you owe tax on the profit, right? So the federal capital gains tax rate depends on your income. It's usually either 15 or 20%. If you donate an appreciated asset, you avoid paying capital gains tax since you're donating it and not selling it. The donor receives a deduction for the full market value at the time of the donation. And again, this is often much more tax efficient than just giving cash. So again, why do this? You're avoiding capital gains taxes, which can be up to 23.8% if you include the net investment income tax for high earners, plus potential state taxes as well, depending on your state. Maximize your donation by giving the full market value of the asset without any taxes deducted. You don't need to sell the asset first, so the charity will just sell it. They usually will just sell it after they receive it. You can donate stocks, bonds, mutual funds, ETFs, cryptocurrencies, real estate, or even things like appreciated artwork if you get an appraisal. The charitable deduction is based on the value at the time of the donation. A lot of times this makes a lot of sense when you're giving larger donations. Here's a quick comparison, donating stock versus selling the stock first and donating the cash proceeds, or just donating cash, right? So we have generous Ginny. She wants to donate $10,000 to charity. She has some cash. She has some stocks that have gone up in value. She bought the stock for $4,000 and now it's worth $10,000. If she sells the stock, she'll realize a $6,000 capital gain. She will owe in her tax bracket 15% tax, so a $900 tax bill. And if she takes that out of her donation amount, her donation would be $9,100. If she just donates the stock itself without selling it first, she gives the full $10,000 to charity, keeps $900 out of the IRS's hands, and there's no tax bill for her. And then there's cash, nothing special there. She donates the cash, she gets her deduction, but she still might be holding that stock that she might want to sell at some point. And when she does, she will owe capital gains tax. Important note here, the stock needs to be held for 1 year. So if you donate a stock that you've been holding for 10 months, 11 months, your deduction is going to be limited to what you paid for the stock, not the current market value. So again, this strategy only makes sense when you've held it for longer than a year. The best way to do this, again, the investment has to be considered long-term, which means you've held it for longer than a year. The best assets to use for this are highly appreciated assets that would trigger a large tax bill if you click that sell button. Especially if you've held stock for a while, it's done well, but you're not feeling so great about the future outlook of that stock that you're holding. So rather than just selling it and paying the taxes, you can donate it, avoid the capital gains tax, and get a tax deduction. There are certain scenarios where it could make sense to consider a cash donation instead of stock. So if your investments have lost value, don't donate that. So it's better to sell first, book the loss in your account so you can use it against future gains that you might have, and then donate the cash, right? So again, this strategy is about appreciated assets, not depreciated assets. If you need the larger 60% of AGI deduction for cash donations in a high income year, cash may make more sense that year. But remember, you can only deduct 30% of your AGI for stock donations. But again, you can carry forward the remainder for up to 5 years. So if you combine this strategy with a donor advised fund, you donate appreciated assets to the donor advised fund. You get an immediate tax deduction for whatever the market value is that day that you donated it. You avoid capital gains. And then over time, you can decide which charities to disperse the money to. Just like Karen just mentioned, important note on qualified charitable distributions, remember, those come from IRAs. You cannot make a qualified charitable distribution to a donor advised fund. So those people, again, over 70 years old, you can't make a QCD to a DAF. It has to go directly to a charity with no middleman. There are no capital gains taxes in retirement accounts anyways, so clicking the sell button in your IRA doesn't trigger a capital gains tax. The appreciated asset strategy to avoid capital gains tax works with non-retirement assets. So qualified charitable distributions, donor advised funds, they're separate strategies. They can be both used in the same year, but for different purposes. Key takeaways for donating appreciated assets. It can be much more tax efficient than giving just cash, depending on your situation. You avoid capital gains, get the deduction. It has to be assets that you've held for at least a year and have grown for this to make the most sense. If your stock has lost value, sell it first, book the loss, and then donate the cash. And remember, donor advised funds are a great way to donate appreciated assets for additional flexibility. Lastly, QCDs is a separate strategy, doesn't have anything to do with appreciated assets. All right, so lastly, we have some more advanced and unique strategies. Most of these, will require professional help, whether from a financial advisor, a tax professional, an estate planning attorney. But it's good for you to be aware of these strategies as they may make sense for you. So we're going to first talk about using trusts. So we have charitable remainder trusts. These are a way to put money into a trust that initially provides income to you or family members. This can be lifetime income or for a set term. After you pass away or the term ends, the remaining assets in the trust go to the designated charity, hence the name Charitable Remainder Trust. You get an immediate tax deduction based on the estimated remainder that will go to charity based on your life expectancy. And this is a good strategy to reduce estate taxes. So if you have an estate tax problem, this is a good strategy to use. It's also a great strategy just to make a charitable impact and still receive income while alive. The next type of trust is called a charitable lead trust. In this type of trust, the trust first makes donations to charities on an annual basis for a certain period of time. You don't get a deduction up front, but when you pass away, you can reduce gift or estate taxes based on the future payments to charities. Once the set period of time is up, the remaining assets transfer to your heirs. Okay, so this is a strategy used by some high net worth families that want to be charitable. They want to avoid the IRS collecting estate taxes, and they want to pass down assets to the next generation tax efficiently. Bargain sales. So this one is actually simpler, right? So this is when you sell an asset to a charity for less than the fair market value. The discount that you gave to the charity is treated as a charitable deduction. The discount must be significant, generally at least 20 to 30% below the fair market value. This will avoid some capital gains just on that donated portion of the asset. This is good for people who want to sell an asset, they want to pocket some money from the sale, but they are willing to donate some of those proceeds. Real estate is used a lot in this example. And then lastly, again, this one's not so much of an advanced strategy either, but it is unique in the sense that most people don't think about it. You can simply just designate a charity as the beneficiary for your IRA, your 401k, life insurance, annuity, really any other account. Assets pass tax-free to the charity. So if your estate is large enough to trigger capital gains taxes, these assets left to charity avoid estate taxes. Large enough to trigger estate taxes, these assets left to charity will avoid estate taxes. If you designate a charity as the beneficiary for an IRA or 401k, charities can withdraw money out of those accounts without any income taxes, where a spouse or your heirs would have to pay income tax as they withdraw money from that inherited IRA account. This is very easy to set up. Just update your beneficiary designation form. This is simple, but speak with an advisor to ensure that it makes sense for your situation. Closing thoughts here, wrapping up. Giving is very powerful, but doing it smartly means more for the causes you care about and less for taxes. I like to say, doing this type of planning is like flossing, right? It's boring and sometimes annoying, but it's necessary and can save pain in the future. I recommend working with professionals, financial advisors, tax accountants, estate planning attorneys to help you maximize your generosity and create a charitable giving plan that works for you and your family. And that's it. Thank you for your time. Really appreciate it. And more importantly, thank you for your generosity to the causes you care about. I really appreciate you all hanging in there and listening to me ramble for a little while. This stuff can be boring, but it's important. So you're doing a great thing by educating yourselves. Thank you again to IEEE Foundation and IEEE USA. We will shift to the Q&A in a few. But again, if there's anything you want to run by me privately, any questions or advice, I'd be happy to confidentially discuss your situation and give you personalized advice. I am also offering complimentary financial planning assessments to all attendees and anyone listening to the recording. So please feel free to use me as a resource. My phone number is below, my email is below, or you can just schedule some time with me using the Calendly link at the bottom of the screen. or feel free to, if you scan that QR code, that'll bring you to the scheduling page. Alrighty, so time for some questions.
Fantastic. Thank you so much, Jorden and Karen. So, folks, we'll leave Jordan's contact information slide on the screen in case you need to capture it. Folks, we are now at the Q&A portion of the webinar. Please post your questions and comments in the questions in the comments section in the live chat section, and we'll load them onto stream for our guests to answer. We did receive some questions earlier, so we'll go ahead and address those first. Jorden, Karen, our first question that we received from audience member Thomas. Thomas asked, are educational 529s a good vehicle to give money to grandchildren beyond the cost of education? I know that's a little bit outside of charitable giving, but in case you had any insight into that.
Sorry, say that one more time. I apologize.
No worries. Are educational 529s a good vehicle to give money to grandchildren beyond the cost of education? Any insight into that?
Beyond the cost of education, no. I mean, you wouldn't have to worry, in the sense that if they don't use it for their education, you can change the beneficiary to another family member. Another thing you can do now is you can roll over, I believe it's up to $35,000 a lifetime to a Roth IRA from a 529 plan for that same beneficiary. So if you have a grandchild that they get scholarships or they don't go to college, whatever the case, they can roll over up to $35,000 to a Roth IRA. Or you can just change the beneficiary to a different family member. You can let your grandchild change the beneficiary themselves to their future children. So it's not going to be completely lost, but it may take a while to be used.
Fantastic. Thank you, Jorden. And thank you, Thomas, for your question. Next question from an audience member, I believe Roger Thornton. Roger asked, how do I know if a charity is qualified under the QCD?
Good question. They need to be a public charity, right? So I would go to the charity itself. The easiest way is to reach out to them. All of these charities, obviously, they want your donations. They make this information very, very public on their websites. So the best thing to do would be to go to the charity just to make sure.
Great, thank you. And just quick follow-up on that. So supposedly, if it's registered as a 501c3, it will be considered qualified. Would you say that's correct?
That is correct. Yep, it is as simple as that. Which that information should be on the foundation's website.
The IEEE Foundation is qualified to receive qualified charitable distributions. I believe that if a 501c3 is considered a supporting entity, which not a lot of them are, but I don't believe they qualify to receive a QCD, or they didn't used to. The law may have changed, but you might want to, as Jorden said, you should really check with the charity. They will know if they can accept a donation. And sometimes it's as simple as checking their website if it's a giving method they accept.
Great insight. Thank you both. Thank you, Roger, for the question. This next question from our IEEE Lone Star section, welcome. For QCD and DAF, you mentioned a contribution limit based on AGI for the year. Is there a lifetime limit on contributions to a QCD or DAF?
No lifetime limits. You can contribute as much as you want. A QCD will have the $105,000 per year, 2024. Now it's 108. Couples can do double that. There's no lifetime. You can do that every single year for as long as you live if you'd like. Donor advised funds do not have any, you can put as much money as you want into a donor advised fund, but keep in mind that there is a limit on the deduction you receive. So there's no limit on what you put into a donor advised fund, but there are limits on the current year deduction, which if you go over those limits can be carried forward to future tax years.
No, thank you. And thank you to our Lone Star section for joining us. This next question from our audience member, Charles. Does the 70-12 age for the QCDs apply for inherited IRAs as well?
That's a good question. I believe you can't. That's a good question. I don't want to give you wrong advice. I believe it does. I believe it does, unfortunately, apply. You have to be that age. I know some inherited IRAs, They will have that 10-year rule where you have to take all the money out. So if you're under 70.5 years old, unfortunately, I don't believe you can just donate that. But let me double check that. That's a really good question.
Thank you, Charles, for the question. This next question from our Lone Star section. When designating a charity as a beneficiary, can the amount of the gift be designated as the remainder of the estate above a certain amount?
When designated charity as a beneficiary, can the amount of the gift be designated? Yes. So you can, on a beneficiary form, you can list 5 beneficiaries, 2 beneficiaries. You can split 50-50. You can do dollar amounts, right? So a lot of this is done with an estate planning attorney in your will. If you want to give away a specific dollar amount, most beneficiary designations on your accounts are going to be a percentage and not a dollar amount. So in that case, it does require a little bit of estate planning if there is a specific, $10,000 amount or $100,000 amount that you want to give to charity as a beneficiary.
Yeah, my experience in seeing how people do this is when you're doing a beneficiary designation through a life insurance or a IRA or another account like that, it's strictly a percentage. So you can't bring in the total amount of your estate into question. I agree with you, Jorden. That would have to be done in a will or through a trust document.
If we're talking about the total value of an estate, that is done with an estate planning attorney and it needs to be in a legal document.
Good to know. Thank you both so much. This next question from our audience member, can we get a copy of the slide set as a reminder of what we learned at a later date? So I believe we've already confirmed with our guests that it is okay to share the slide deck. So we will include that in the follow-up email that we send out with the feedback survey following the end of the live broadcast. Please make sure to fill out that feedback survey, and we'll make sure that you get all the resources that you need. Also, for audience members who connected to this live stream through a link that we sent out, you can access the webinar's videos again at any time afterwards. So definitely feel free to share them to your networks. This next question from our audience member, can you give to a charity you set up from DAF?
Charity that you set up? Yeah, I don't see anything wrong with that. I would double check, with your attorneys, accountants. But yeah, there's no reason, as long as you're a 501c3 and the donor advised fund. Really, when you have a donor advised fund, you have to recommend grants out of the account. There are certain cases where Fidelity or Schwab will say we can't send money to that organization because we don't know what it is or it's not a public charity, so they can decline your grant. But in most cases, you should be.
Awesome, thank you. Hope that answers your question. Same audience member also asked, please explain CLT again.
Sure. So in charitable lead trust, you put money into the trust, right? So you put assets or cash, stocks, whatever it is. It's irrevocable, right? You can't take it out. So once it's in the charitable lead trust, it stays there. In this type of trust, the trust is first going to make donations to charities on an annual basis for a certain period of time. The deduction that you get will be based on the future payments to charities. Right, so you don't get a deduction up front now, but when you pass away, you can reduce gift or estate taxes based on the payments to charities, the future payments. So once that set period of time is up, the remaining assets, right? So let's say it was 20 years of donations to a charity, 20 years is up, whatever's left in the account at that point will transfer to your heirs. It lowers your estate tax bill, and you can transfer assets to the next generation very tax efficiently.
Fantastic, thank you. Next question from our IEEE member, Ebony Walker. Great to see you. Can funds in an HSA be used in a QCD?
Good question. Unfortunately not. HSA funds, unless, have to be used for medical expenses, premiums, or, really any medical expense. You can use it for a lot of things at the drugstore even. But no, you can't use it for a QCD, unfortunately.
This next question from audience member Craig. Craig asks, if I have cash in an IRA, does cash qualify as a QCD?
Yes, it does. Anything in an IRA, it doesn't matter what assets are in it. When you take a qualified charitable distribution from an IRA or a distribution in general, it's distributed as cash. So if you were to send $10,000 straight from your IRA, you actually would have to sell some assets in the IRA to free up that $10,000 first. So you are clicking the sell button in the IRA. That doesn't produce a taxable gain because there's no capital gains tax in IRAs. And then it's in cash, and then you transfer the cash. So yes, you have to distribute cash as a qualified charitable distribution.
Great, thank you. Craig, hopes that answers your question. I also see another question from our IEEE member, Zafar Utakfi. Great to see you again. Assuming you're the same person. For a retired person not making any money, how can he transfer his IRA/401k to the Roth?
So that's called a Roth conversion, right? So you open up a Roth account. Usually it's easiest to have them both in one place, right? So if you work with Fidelity, for example, you have your IRA at Fidelity, you open up a new Roth account, and it's as simple as calling Fidelity and saying, hey, can you please transfer $20,000 from my traditional IRA to my Roth IRA? All of the money that you transfer to your Roth will be taxable in the year that you do it. So as if you earned it, right? So if you transfer $20,000 to your IRA from your traditional to your Roth, that's $20,000 of taxable income in that year, which, remember, watch out for IRMA. The IRMA limits, Roth conversions can push you into those IRMA thresholds. So if Medicare premiums is an issue, just be wary of that.
Great, thank you, Jorden. Audience member James asked, when moving money into a DAF, if you're 63 or older, what? Okay, so I'm sorry, apologies. That wasn't the question. That was more of a statement. Watch out that it doesn't increase your AGI so that it triggers Medicare IRMA. Thank you for that, James. Do you have any? Do you have any?
Yeah. So when you move money into a donor-advised fund, you're moving non-retirement money, right? So it's money that has already hit your bank account. So whether you took it out of your IRA, you paid taxes on it, now it's in your bank account, or it's just money that you have in a brokerage account, any non-retirement account, that goes into a donor-advised fund. So moving money into a donor-advised fund does not increase your taxable income. Okay, so again, it would only, when you trigger Medicare, IRMA premiums, that's when you are taking, producing taxable income, which happens when you take money out of a pre-tax IRA, a traditional or a rollover IRA, or a 401k plan.
And Karen, did you have any additional comments regarding that?
I was just going to ask Jorden to articulate a little bit further what of these strategies might help a person avoid triggering Medicare, IRMA for Medicare.
Right, so that would be a qualified charitable distribution, right? So if the IRS is forcing you to take, $30,000 out of your IRA this year, you don't need it, right? You have Social Security, you have other sources of income, and then your taxable income, you're being forced to take $30,000 more in taxable income. Donate that $30,000 as a qualified charitable distribution. Do not let that money hit your bank account. Just move it directly from the IRA to the charity, and you will not, that won't add to your taxable income and will not add to your income for IRMA purposes.
That's something we actually hear a lot at the IEEE Foundation from a number of our very loyal annual type donors who really will say to us, I'll figure out what my taxable income is going to be in the middle of December, and then I'm going to send you a QCD because I don't want to pay IRMA. There's at least 20 plus donors that tell us that annually. So it's a great strategy people have discovered.
Yep.
Great. Thank you both for clarification and insight. And James, really appreciate you chiming in on the discussion. This next question, what are the benefits of a charitable elite trust?
It mainly is the avoidance of estate taxes, right? So I'll go back here. If you have a taxable estate, which I'll use my cheat sheet here, I believe it's over $28 million in your estate. So it's right about 28 million. So it's a large estate. So anything over that would be subject to estate taxes. Those can change, right? So the estate tax exemption can be lowered by legislation. So who knows what it'll be in 1 year, 10 years from now. But charitable lead trust, the main benefit is the avoidance of estate taxes and tax efficient transfers to your beneficiaries. And of course, being charitable.
Great. Thank you so much. So I think that's it for our audience members' questions so far. While we're waiting on more, Jorden, Karen, have some questions of my own that we'd like to ask. So first up, who do I talk to about including the IEEE Foundation in my estate?
I'll take that one. So you can contact the IEEE Foundation. You can email us at donate@IEEE.org, and we'll route you to the right team member, who is Danny DeLiberato, who will answer all of your questions. But there's a lot of information on our website, IEEEfoundation.org. There's even an interest form if that's the direction you'd like to go, so we can really hone in on what your questions are and your desire and your interests.
Fantastic, thank you. And folks, we have included the link to the Foundation's website below as well in case you need to reach them. This next question, also kind of a follow-up. How do I make a tax-deductible donation to the IEEE Foundation?
Oh, there's so many ways that we accept donations, everything from online giving using a credit card to all of the techniques that Jorden explained today, to many of you give during your dues renewal. So there's an option to make a donation through dues renewal. Again, that would be cash today. And you can also include us in your estate plans, which is a gift for tomorrow, but certainly lifting IEEE to the level of family if you opt to do that.
Fantastic, thank you. Can I name the IEEE Foundation as my DAF beneficiary?
As Jorden said, you can name any charitable organization to be the DAF beneficiary, and that can happen in a variety of ways depending on what your DAF administrator allows you to do. Some will name a perpetual annual donation to come out of their DAF. Some will say distribute the DAF. Other people will have their DAF go to another advisor, so the DAF gets taken over by a family member. So you can absolutely do what the question is asking, but you have to talk to your DAF administrator to find out what their options are, because all the options are limited by what they're willing to allow their DAF holders to do. Jorden, did you want to add anything? I think that's...
Oh, Jorden, I think we've, or actually, I think you were muted just now.
That was my fault. Karen, I think you pretty much covered it all. Like, when you pass away, you can list, your spouse or an heir to continue your legacy of charitable giving. So, they're basically making donations on your behalf after you passed away, which is nice. Or you can just list a single charity, or you can split it up, 50-50, to be the, just to receive whatever's remaining in the balance at the time of passing.
Great, thank you both. Since we are approaching the end of the hour and end of the webinar, close it off with final couple questions. This one's for either of you. What resources are available for donors who want to learn more about planned giving?
So there was some information included in today's webinar. There's information on the IEEE Foundation website at IEEEfoundation.org. Later in the year, we'll actually be doing 2 more webinars with IEEE USA. One will be in August, which is Make a Will Month. So we will be focusing on wills and estates, and then we'll be doing another one in October. That will be during Estate Planning Week in October. So we do webinars. We're working with IEEE USA to do that. There's information. You can subscribe. We distribute a newsletter and a couple of e-newsletters around planned giving every year. So just come to the foundation and sign up, and we'll help keep you informed.
And folks, we will be sending out emails to all of our past registrants and webinar attendees regarding these upcoming webinars as well. We'll be promoting these in the coming months, so keep an eye out for that. Final question. What advice would you give to someone considering a significant charitable contribution to the IEEE Foundation?
Do you want to hear from the financial person first or me?
Feel free to jump. Either one of you, if you'd like to jump in first, feel free.
Jorden, why don't you give some advice on what people should do when they're thinking about making a significant charitable gift?
Sure. I definitely would recommend working with a professional. Someone who's considering making a significant charitable contribution likely has significant assets, and there may be multiple different accounts, best assets to use to do this, best ways to do it. So I always recommend getting professional advice so you just be 100% sure you're doing it in the most tax efficient way possible. No reason to give the IRS extra money, if you don't need to.
The other thing I would say is contact the IEEE Foundation. One of our development officers, Michael Deering, Eileen Heltzer, Danny Deliberato, would be delighted to work with you to match your interests and intent with the parts of the IEEE that you are most passionate about. That is what we are here to help facilitate, and then work with you and your advisors on the best assets to fulfill that gift. So really, our objective is to connect you to the parts of IEEE that you are most philanthropically inclined to support.
Fantastic. Thank you both. So, folks, unfortunately, we are out of time. I know we could go a lot on and about this, and be assured that we will go into more depth regarding these important financial topics in the near future. Karen and Jorden, thank you both so much for joining us today and providing.
Jonathan, one last point. We always
Sure.
like to remind everybody that the information that was shared in this kind of session is truly educational, and always check with your own personal financial and legal advisors before making decisions.
Mm-hmm.
Absolutely. Great advice. Thank you. And also, finally, one thing from our audience members, you can reach the IEEE Foundation at donate@IEEE.org. Thank you. But as I was saying, thank you both so much for providing your expert insights and how we can turn our good intentions into meaningful action while also being able to maximize our tax benefits at the same time. I really appreciate both of your insights today, and thank you so much.
Thank you.
Thank you, Jonathan. Appreciate it.
And thank you to our audience for tuning in and for your great questions. Before we end things off, a few quick announcements. First, there we go. First, there are still spots available for the Nexus Cyber Institute Certified Chief Information Security Officer, or CISO training in Huntsville, Alabama, from March 24th through the 27th. This training offers executive-level preparation for professionals aiming to excel at the highest levels of security profession. It is tailored for current C-suite leaders as well as those aspiring to step into C-suite roles. Be sure to register before the class fills up. Next, mark your calendars for a new iWork event coming this spring on May 15th. The IEEE USA Innovation Workforce and Research Conference will convene stakeholders from industry, government, and academia in Portland, Maine. This full-day summit will provide a platform for meeting potential partners, exploring federal technology initiatives, and learning about government small business programs that foster innovation in the Northeast. Stay tuned for registration details, which will be available on the website soon. Finally, for those who missed the announcement, IEEE USA is setting sail to the Western Caribbean this fall. Join us aboard the Royal Caribbean's Mariner of the Seas as we cruise from Galveston, Texas, to exciting stops in Costa Maya and Cozumel, Mexico. Please note that participation in IEEE USA Western Caribbean cruise activities requires booking through our official portal. The link has been provided below. Cabin categories are filling up fast, so you absolutely will want to secure yours as soon as possible. And don't log off too soon. Stick around after the webinar for a exclusive sneak preview of what's in store for this year's cruise. If you liked the content presented in today's webinar, be sure to check out our other ones. We have an entire catalog of presentations available for your viewing pleasure on our IEEE USA website. And if you haven't already done so, please don't forget to like and subscribe to our channels and check back daily on our social media for future live stream updates. Have a great day, everyone.